Renewed trade tariffs imposed by the United States, global inflation and tension in the Middle East are posing a risk to the global economy. However, the softening of the US dollar is projected to continue for the rest of the year, having a positive impact on the equities and local currency bonds in the emerging markets. This is according to the Standard Chartered Bank Global Market Outlook for the second half of 2025.
The International Monetary Fund projects that the global economy will slow down to 2.8% in 2025 on account of greater policy uncertainty, trade tensions and softer demand momentum. Standard Chartered Bank, in its global market outlook for the second half of 2025, projects that the dollar will continue weakening. This, the Chief Investment Officer, Manpreet Gill, says is good news for emerging markets like Kenya.
What's really interesting is that periods of a weak dollar tend to actually be really good for financial markets, for equities, but particularly non-US equities. But we should expect some volatility. These things never happen in a straight line. And we do think we'll see many more interest and opportunities outside the US, wave moving our equity overweight to Asia ex-Japan, for example.
On the renewed tariffs by the United States that have occasioned reciprocal tariffs, the bank says there will likely be more clarity on the impact on trade over the next 2 months once ongoing trade talks are completed.
One is, I think, in the next month or two, we're going to get a much tighter framework in terms of what actual trade deals between the US and various markets around the world and including Africa look like. And I think that's going to give the market some indication on when tariffs ultimately end up. And we think there's a good chance they'll be not quite as bad as was initially feared in April.
Manpreet says the impact of the tensions in the Middle East should be minimal on oil prices as long as oil supply is not disrupted.
But what markets care about, and markets always have a narrow view of the world, right, is they were singularly focused on whether actual oil supply was likely to be disrupted. And I think that brief rise we saw towards $80, we never quite got there, was pricing in a non-zero chance or probability that, wait, maybe we need to pay some attention to this. But I think fortunately what we ended up experiencing is that while there is a geopolitical issue that is at hand, direct interruption of supplies did not happen.
Betty Kiptum, Prime Edition.